What's going on, y'all? Welcome back to the Mining Pod. Today, we've got an awesome show lined up with Mostafa Al-Mashita, the co-founder and director of sales and trading at Secure Digital Markets. Y'all probably have not heard of Secure Digital Markets before if you're just a passive investor in Bitcoin mining stocks or a passive enjoyer of Bitcoin mining news, but they're in the background of a lot of financing and capital markets movements for a lot of the major names within the North American Bitcoin mining sphere. So really looking forward to this conversation with Mostafa. All of these topics with regards to capital markets, financing options for miners. It's one of the underexplored topics when we look at the lifeblood of this industry, but it is absolutely crucial to make sure that these miners can continue to expand and invest in their operations. Before we get Mostafa on the stage, a quick word from our sponsors.
Are you a retail or institutional investor interested in Bitcoin mining companies? The Miner Mag brings you free data and analysis from all major NASDAQ-listed Bitcoin mining operations to know who stands out. Check out visualized metrics and data-dependent stories at theminermag.com. Thanks for listening to The Mining Pod. Want more? Subscribe to our main feed on Apple, Spotify, YouTube, or wherever else you get your podcasts for another weekly show on Bitcoin stocks. And check out our newsletter at miningpod.blockspace.media today.
And we are back, and I am thrilled to invite Mostafa onto the stage so we can chop it up. Mostafa, how are you doing, man?
I'm doing well. It's Monday. We have an exciting week ahead of us, and I'm excited to be on the show. Thank you for having me.
Yeah, absolutely, man. Exciting is definitely a euphemistic way to put it. You're calling in from Canada, but still, I think the entire world, for better or worse, has their eyes on the U.S. elections coming up. We're recording this on the Monday before the elections tomorrow. We're actually going to talk a little bit about potential impacts for the presidential election and the outcomes therein on capital markets within Bitcoin, also the macro picture. But we're going to save that for the end because this is not a political show as much as sometimes I wish I could make it one. And we're going to just dive right into lending, capital markets, financing within the Bitcoin mining industry. Before we get to that, though, I would love for you to just take a quick moment, talk about Secure Digital Markets, give some color to what y'all do for some of the viewers who might not know the kind of business that y'all run.
Definitely. So Secure Digital Markets is an OTC trading desk. We're based out of Toronto. We have offices worldwide. We have an office in the US, London, working on a few different offices in a few different other parts of the world, a few offshore parts of the business. So our main bread and butter is our spot trading desk. We service a lot of clients in a number of different automated ways and also high-touch RFQ chat trading. We have a lending desk that we've also launched out a few years ago. It's now grown to be close to be a $50 million book of business now. We also launched our derivatives desk last year, which is picking up steam. We have a lot of clients coming in to hedge their book or to do a Texas hedge, add on more exposure to their holdings. So that's been a growing part of our business.
Awesome. And with regards to the Bitcoin mining industry, because I know that y'all have financial products that span really just the general Bitcoin ecosystem, right? But with regards to Bitcoin miners specifically, what kind of products and services do y'all offer and which are the most used, would you say?
Definitely. So with Bitcoin miners, we have a number of different levels of interactions with their financial teams. First and foremost is our spot trading desk. So we allow clients to liquidate part or whole of their daily mined coin in an automated way. So our auto sell function allows clients to point their Bitcoin mining rewards towards a wallet address that we provide to them. And once the funds are landing in this Bitcoin wallet address, the funds are being automatically converted after 2 or 3 confirmations to the fiat currency of their choice. And this happens on an automated fashion for clients on a daily basis, serving, two main benefits. Number one is the ability to hedge without having to control for Bitcoin price. Coins sometimes land at 5 a.m., 3 p.m., depends on the mining pool that you're using and depends on your jurisdiction. So you might need to be awake if you're sensitive to that hedging need, and you don't want to be waking up to a lower Bitcoin price if that's not your strategy. The second benefit is that you're able to then provide the ability for your clients to then secure a better term with the energy provider. So rather than having the need to put in a large deposit with the energy provider, you're able to move away from that as the energy provider is getting wires on a more consistent basis. So that's a pain point for you as a miner. Then that's something that we can assist with. Our lending desk allows clients to take a loan against their Bitcoin holdings instead of liquidating those Bitcoin holdings. So if you're a long only, Bitcoin miner and you're not looking to get out of your position here, as we've just barely passed all-time high and we're now hovering at 67.5, then you can take a loan against your Bitcoin holdings, utilize the cash for 12 months or however long you need, and then pay off the loan and get your Bitcoin back. So that's always interesting for miners looking to improve their operations, grow out their farm in such an opportune time prior to kind of the market continuing on its 4-year liquidity cycle. Last but not least is definitely our derivatives desk. So derivatives can be extremely powerful for miners. You have the ability to, first of all, liquidate your coins through a deaccumulator strategy. You have the ability to hedge your exposure over the next quarter if you've seen kind of price go above your threshold of what's interesting. You can start adding in some hedges, quarterly expiry hedges, annual hedges, and some miners might need that from a risk management perspective, from what their investors want them to do. So different miners have different needs. I think that another really popular strategy that's popping up now is some people have a sell price goal of, say, $80,000. Well, that's pretty close. You can probably get that if you do the basis trade, which is putting up your coin in spot, and then you're selling the futures against that coin. So that's a very popular strategy for miners, for anybody that's looking for a bit of passive income on their Bitcoin.
You mentioned the auto liquidation feature, and I'm curious, the majority of miners opt into that, or maybe do they put like a portion of the coins that they mine into that? And a second part to that question, do you see changes in those trends in bull versus bear cycles? Right? Because I think one of the things that I keep coming back to from the 2021, 2022 cycle is all of these miners were beating their chest on press releases about how many coins they were stacking, and then Bitcoin pukes, and then they're selling coins that they mined at 50 and 60K at 40, 30, and 20K. So it's kind of a two-part question. Would you say the majority decide to auto-liquidate for the reasons that you specified? Also, they've got to cover their bills. And would you say that you see different trends based on whether or not Bitcoin's ripping or dumping?
Yeah, I think that what I've noticed is miners that turn it on typically don't ever turn it off, but they rather eventually send off a smaller portion during times during trending times. So I would say we're still in a trending time. Obviously, it's a very sensitive week given the elections popping up, but just generally before this, we were in a trending zone, right? So miners will keep a portion of their Bitcoin, and then we'll see some requests for a lump sum liquidation, and that works out well for them because they're holding a larger portion, but they're still maintaining the need to liquidate what they need for a CapEx perspective, OpEx perspective. But they're keeping a smaller lump sum that is their quote unquote savings. And so that works out well for some miners, especially for the private miners. Public miners, I think the strategies we've seen work very well when you have that ability to access capital. But yeah, private miners, we've seen a lot more auto sell during bear markets. It really is a defensive strategy. However, I do think that it depends largely on your treasury. I know some miners that are cutting it down to the wire, and some miners that have quite enough to sustain operations for 6 to 12 months, just in dry powder, able to sustain their ability to operate. Bitcoin's not likely to get a 50%, the drawdown from here, in the next 6 months. I would say that with a 90% confidence rate. but miners still have to be prudent. And so for their auto sell strategy, it just depends on their costs and their operational capacity.
Right. Another example or, reminder that every miner has a different setup, right? And a miner with a lower cost of operations and a lower cost of investment into their operations are going to have obviously different considerations and different risk tolerances and appetites, right? And I think that really plays into the treasury management piece, because a lot of miners really, especially in the older days, were kind of degenerate gamblers in a way. Like, this is a high risk, high reward industry to front a lot of capital. And you're hoping to obviously mine Bitcoin at a lower cost than spot. But we've seen treasury management strategies continue to mature, I think. I think a lot of miners, and you'll have this chart that you sent me for the show about how after the halving, they continue to sell more coins than they were before, which makes total sense. Margins are much thinner right now. Hash price has been range bound between like $35 to $50 per petahash per day since the halving. With regards to treasury management, what you just touched on there, I also want to go back to the idea of some of the derivatives that y'all offer and some of the trading strategies that you've seen. So, with regards to leveraging things like options and other kind of derivatives contracts, would you say that generally speaking, miners over the last year or so have become more sophisticated in their trading strategies? Were they always using some of these tools? I mean, I guess all of this to ask, how much better are they getting at both managing risk and also capitalizing on the Bitcoin that they do have in their treasury? Like, are they putting it to work more? How are you seeing some of these trading strategies develop?
Definitely. I think that the private small to mid-sized miners are definitely educating themselves. Over the last 12 months in particular, I've seen a lot more of the small to mid-sized miners come in and ask for a little bit of an education or a seminar, asking for the understanding of what does it mean to earn a yield versus what does it mean to protect myself. And the reason those two are different is because, buying a call versus selling a call, depending on where the market is, you're either earning a premium for that or you're paying a premium to hedge yourself. And so they're starting to ask these questions. They're starting to figure out, should I get a call spread in? Should I just so it's costless? And how far in advance should I be hedging my exposure? Certain trades get extremely expensive in times of high volatility. And that can also be very lucrative if you're trying to put your balance sheet to work. Again, the small to mid-sized miners are mainly approaching it from let's look at this as a way to hedge our balance sheet and to hedge our exposure to the industry. The mid to large scale miners are coming in from a perspective of, hi, I have this current, cash flow coming in from Bitcoin. I want to protect my inventory. I currently have an inventory of Bitcoin and also mining machines that also represent the price of Bitcoin, but on a higher beta, manner. So how do I hedge myself, right? And so you end up in a little bit of a different conversation for the smaller and larger miners. It's some are educational, some are let's take it to the next level and also hedge my equipment. So it gets very interesting.
Yeah, the hedging the equipment part, I want to put a pin in that and come back to it later, because you said, the ASICs are a high beta play to Bitcoin. That's putting it mildly in a lot of regards. It's more volatile than your favorite shitcoin, right? I mean,
oh yeah,
S19s at the peak of the last cycle were going for $12,000 at the peak. Now you can get one of those for like 200. It's you're always rolling the dice with these things, but most miners understand this. But kind of just to wrap up on some of the hedging strategies, there's been a trend, or at least I wouldn't say it's been a trend, but a trend that has been anticipated with a lot of people that I've talked to within the Bitcoin mining industry, different professionals or folks that work at Luxor, because they have a hash rate derivatives product. I used to work there, and they're of the mind that if not already, all of the major public miners and private miners are going to have basically like a trading desk in-house, like some analyst or some trader who's sitting and doing what you see at other commodities producing companies like oil producers and gold miners and things like that. And you're going to have someone in-house who's basically trading derivatives or executing trading strategies that help position the company for success. Are y'all seeing that on y'all's end for with the companies that you service, or do you expect to see this more in the future? Is that even true? Is this a trend that's actually coming to reality from y'all's perspective?
I think the short answer is yes, and it's interesting because it started out with everybody jumping into trading ASICs. So almost every single company launched quote unquote ASIC, trading desk. And the reason for that is simple. The market's quite large and there's a lot of new entrants and the market's becoming more global than ever. So it started there. And now I'm slowly seeing, more and more point person, dedicated individual. Sometimes it's the CFO, sometimes it's somebody sitting under the CFO that is directly handling the firm's trading. And it's actually a very positive trend for these miners as they're taking their operations more seriously and looking to capitalize a little bit more on the Bitcoin that they're mining. So ultimately, it's a trend that helps these miners survive the winters and take advantage of the bull run. I think people tend to overshoot over where Bitcoin will end up hitting as far as targets go. We might hit 250K or 500K this cycle. I think it's a little bit of a moonshot goal, and it makes for very interesting headlines. But if you're sitting there at 120, 130K, pounding your chest, saying we should take some profit, and then the rest of the company's like, no, we're gonna go to 200. That's the hardest point. That's the hardest point. Nobody wanted to take profit at 7K. Last time we were there. So these individuals will be typically more level-headed and don't approach the market from an emotional view.
That's a really good point. And when it gets frothy, that's when people start having less, lucid decision making, we'll put it, or the kind of exuberance takes over the more rational parts of our brains. I think you've seen that in a few cycles. I mean, everyone thought Bitcoin was going to 250K last cycle, right? Obviously, that didn't happen. Now, we could have an entire other podcast as to why that happened and whether or not FTX and Alameda had a hand in stunting the growth of it. Maybe we'll put on the Alex Jones tinfoil hat a little bit later. But I'm glad we keep coming back to ASICs, and maybe this is a kind of a good segue. We've kind of covered the derivatives and hedging part of the business. I want to start talking about lending. And so y'all offer Bitcoin-backed loans. If I recall correctly from the beginning of the conversation, 65% loan to value. Is that correct?
Yeah.
And then 75%. What was the 75% for?
So 65% loan to value, 70% margin call. It's a non-recourse loan, typically 12-month long terms. We have a bit of a minimum, so minimum, call it 250 to 500K. But for friends of the miner mag, we'll make it 250. So for us, it's a matter of allowing clients to get access to capital that's sitting within their Bitcoin, but not putting themselves through any sell pressure or unnecessary tax bills. So clients really appreciate this because to be continuously competitive, again, as you mentioned, hash price is sitting within a range, but it's been hitting all-time highs. And miners need to compete, continuously make sense of their capacity, and so that's a good way to leverage the Bitcoin that you have. Is to instead of liquidating, you're sitting on it and you're able to pay it back and get your Bitcoin back if you need it. But 65% loan to value is very favorable for these firms. The main thing in this industry, though, is especially for a Bitcoin miner, is just having that accessibility to capital. Bitcoin mining is extremely cutthroat. Things move very fast, and some parts are very hard to come by. There was I remember when I was working with a few miners a little bit more closely and investing in some miners. There's a whole era where people were unable to get transformers. It's a little bit easier now, but sometimes the lead time was 8 to 12 months. So that's extremely difficult to operate within. So you need the ability to have access to capital in order to be able to pounce on those opportunities when they come by, instead of having to secure the capital financing while you landed the part that you're looking for, and especially if it's expensive, or the site that you're looking for.
In the competitive world of Bitcoin mining, one name stands out: CleanSpark, America's Bitcoin miner. At CleanSpark, efficiency isn't just a goal, it's our standard. Our sophisticated facilities are built and led by expert teams who care about Bitcoin and the communities we work in. Scale, we've mastered it. Our large-scale operations have set us apart in the industry as examples of community-oriented building. Our track record speaks for itself. We navigate the complexities of the new economy with precision and with skill, continuously achieving operational milestones. Curious about how we do it? We invite you to discover the story behind CleanSpark's success at cleanspark.com.
And generally speaking, these Bitcoin-backed loans are kind of the only avenues for especially these private miners. I mean, public miners have hard enough time securing financing that doesn't involve, dilution or, issuing new shares or backing a loan with Bitcoin. At this point, this is kind of the only option. And going back to the ASICs, we saw back in the last cycle, ASIC-backed loans were extremely popular. There was a brief point there. You had a bunch of different lenders. You had Galaxy, I believe another one was like White Owl. You had Foundry, a few others that were a part of this pretty small cottage industry of ASIC-backed loans. And these completely blew up in a lot of people's faces, both the lenders and the miners. Do you think we'll ever see those again? Do you think there is any way to actually structure an ASIC-backed loan that makes it not as risky? And just to give some color to our listeners who might be lost in all of this, part of the reason why these ASIC-backed loans are so difficult is exactly what we were talking about earlier. ASICs are extremely volatile. When Bitcoin's ripping, they're super high beta play. And if you trade them right, you make out with a lot of money. When Bitcoin's dumping or hash price is dumping, then you're underwater, and these things can be extremely difficult to liquidate. This is not like Bitcoin where there's a 24/7 market. You can just sell it and it's easy. This is like trying to sell a used car, right? So all that to say, do you think that there is a future where these loans become more prominent again, or is there another way to structure them that actually makes sense? Or was this just a bad idea to begin with?
I think you'll definitely have some lenders jumping in. Somebody will want the market share, and somebody will get in the industry as a new lender or as a new, financial provider, and they'll think there's a massive opportunity there. And they might be right. There might be a new way of structuring it. But ultimately, you're lending against such a extremely fast appreciating asset. It's going to be a little bit difficult for them to price it right. And if they do, people might take advantage of it in the opposite way. So it might pop up again. I think that it'll take some time for it to be priced effectively, and maybe hash rate futures will help the lender hedge effectively, depending on what's going on in the market. But currently I think it's a very difficult instrument to offer. Miners absolutely, especially the small to mid-sized miners, they love it. For the lenders that have done it in the past, well, you've all welcomed them to be new miners, as that was the kind of forced outcome. So some of them survived and made it as new miners, and some of them are no longer seen at the conference floors.
Right. And that's a good thing to point out too. And in most of the cases, these lenders are actually legitimately seizing the infrastructure and then mining to cover the rest of the loan, which is, I don't want to say unique, because very few things are unique, but I can't really, and you could speak to this better than I could, I can't really think of anything else in the realm of financing where it's like the lender is taking a productive asset and then using that productive asset to pay off a loan that was defaulted on. Right? Is there anything that kind of is even analogous to this in the traditional world?
Maybe, some parts of the equipment world for high-end construction equipment.
That makes sense.
You have some similar.
Right.
But it is quite rare, especially when they have to go search for power if they can't host it in the same place. So then you're sending, people to come in and collect the ASICs. So it can get quite intense. But that's the thing about the mining industry as well. It's one of the first hustles in the industry and provides such a large backbone for the industry. But then you still have probably some of the largest percentage of lawsuits popping up on a monthly basis relative to any other part of the industry. So
it truly is the Wild West. And I think this conversation of ASIC loans really encapsulates how unwieldy and unattractive they are from a financer's perspective. Unless you're just extracting in just crazy, or you're brokering insane terms that are super favorable to the lender, it just doesn't seem like it's worth the headache. And as I understand from talking to one of the, he's not an executive, but he's a pretty high up guy at NYDIG, which was one of the companies that would offer these loans back in the day. One of the things that really made them untenable is just the fact that interest rates have risen, obviously not exponentially, but meteorically over the last couple of years. I think the Fed's fund rate peaked at like 5.5% or something around there. And that has obviously had ripple effects in everything from mortgages to car loans to student loans to anything, right? Obviously, it affects lending markets all across the board with all of these different economies. How has that impacted y'all's business and lending within the Bitcoin mining market specifically? There's the obvious one, right? Rates are going to go up. So 2 questions there. How has it impacted, and what are the average rates that y'all are seeing now that you're able to secure for miners like currently versus a couple of years ago?
Yeah, definitely. I think it's a great question, especially as miners look to see different financing opportunities. I think that the current market, you see this also with banks, but even though the Fed rate's gone down, some banks haven't, adjusted for that yet in the terms that they give out to their clients. And that includes some mortgage rates and then definitely credit card interest rates. So there is a bit of a lag experience there, and there's, many good reasons for that lag. We don't have to go too into it now. I think that overall, our current rates are pretty reflective of where risk is. There's a certain carrying cost of having Bitcoin on your book, and certain carrying cost of being in this industry as a whole, including some regulatory items and matters that just cost a lot more than the typical industry. So the current rates are somewhere sitting around the neighborhood of 8 to 8.5%, and that's, I would say, very competitive, given the fact that the majority of the banks in the US specifically are not currently providing, the ability to take out loans against your Bitcoin. I think we'll soon see the ability to take out some loans against your Bitcoin. The ability to take out loans against your ETF will definitely rise in popularity. So that's a large, conversation to be had. I think some people are very particular about the way that they want to see loans play out. Tri-party agreements, multi-sig wallets, et cetera, et cetera. So, we'll see dynamics shift over time, but banks definitely need to jump into the space. I think that obviously we have a little bit of a dark cloud over banking and digital assets currently on, we'll leave it at that. It's a little bit of a difficult landscape. But I think that in the next 12 months, hopefully, we'll have a little bit more regulatory clarity about how to get better access to lending terms. And the banks really are key here to be partners of groups like us and miners to help them get access to these loans at cheaper rates.
So for the regulatory clarity thing, I want to follow up with that after this question, because I think it's important to contextualize what the difficulties are now versus what could maybe improve conditions so that miners have better access to lending and financing. How does the ETF change things though currently? Because you kind of just mentioned it. I think the simple obvious answer that I can understand from what you just said was you can borrow against the ETF in a way that is much more palatable to a financial institution. But in what other ways does the ETF help? Is it not just that, but also that it helps lend more credence and legitimacy to the industry? Are there other aspects or considerations that help in the financing world now that there's an ETF out for Bitcoin?
Yeah, there's quite a lot. I think that just recently, over the last 2 weeks, we saw the Michigan Pension Fund. So the state of Michigan now owns 110,000 shares of the ARC BTC ETF. It's about 7 mil USD notional. So you look at that and you ask yourself, is this going to be possible to do otherwise? Is the Michigan Pension Fund going to sit there with a ledger or, a treasurer and be their own custodian? Yeah. Are they going to leave their coins on Coinbase? Are they going to leave their coins with, whoever else? And so, we're typically non-custodian by nature. So, we're doing a trade, we're settling a trade. And that gives our clients a lot of comfort and a lot of values derived from that, for both ourselves and for the clients. The UK pension fund as well, this was today, they announced a 3% allocation to Bitcoin. These are significant numbers
whoa. The federal UK, the UK's federal pension fund, is that right?
UK pension fund. Let me look this up. Bitcoin. It's called
fact check you on air, but or during the recording.
No worries. But it's called Cartwright.
Wow, that's crazy. Okay, yeah. Cool.
And they're also launching a Bitcoin employee benefit scheme, which is incredible.
3% is big.
Yeah. So that's about $60 million. So, to answer your question, that is only possible when you're sitting there and discussing flows through ETFs. Right. Ultimately, again, it'd be pretty hard to see them. Bitcoin is a bearer asset, and that is the beauty of Bitcoin. But you have to, I think it was Eric B. I'm going to butcher his last name, so I'm just going to say Eric B., the ETF specialist. He was always preaching the fact that the ETF flows and the ability to understand how much will be possible with these ETFs will only come with 12 months. It takes a while to get that adoption. And so now we're slowly seeing that with these headlines.
Do you think that the ETFs, to kind of return to the question that I put a pin in before that one, probably the biggest consideration for moving the needle in terms of mainstream acceptance of Bitcoin? I guess all of that to say, to kind of ask the question that I asked just then in another way, are we opening the door to a world where financial institutions and lenders are going to be more comfortable with lending to Bitcoin miners and other Bitcoin companies now that the stigma is slowly being chipped away?
Yeah, 100%. I think when I first started, call it professionally in the industry, was around 2018. So let's just start with 2019, 2020. I'd go to conferences, and so we'd go to a lot of family office conferences. We'd go to a lot of, institutional capital conferences, and, we'd be talking to these large funds, a couple $100 million, billion-dollar funds. And we tried to, get them on the Bitcoin standard, convert, a small fractional percent, 0.1% into Bitcoin. And the main question I would get asked back then is why? And then, you'd explain the whole pitch. 2023, 2022, and the why started becoming how. That question would shift. And instead of saying, why am I going to get in this industry? These funds are asking, how am I going to get in this industry? So they get in the, rhythm of trying to figure out what's the right way of doing it. And then you have risk managers, you have extremely regulated processes that they have to abide by. And typically what will happen is that, the ETF is a pretty fast way to fast track that approval. And then I think potentially over the next 12 months, we'll see a lot of companies educating themselves on being their own custodian and holding their own Bitcoin. So you might see them sell off some of the, ETFs and start to pick up spot BTC and be their own custodian. I don't know, but it might be a trend that might pop up for some private funds versus, the pensions and the regulated entities.
All right. So last question with regards to lending, and then we'll get into everyone's favorite topic, which is the 2024 presidential election in the US and the aftermath, specifically with regards to Bitcoin markets and Bitcoin mining markets, and also macro in general. But I wanted to close on the topic of lending, looking at private miners versus public miners. Now, I don't think it's any secret to anyone who's listened to this show or anyone who follows these markets closely that the public Bitcoin miners just have, greater access to capital. They have more tools at their disposal. If they can't get loans, then they can dilute their equity and issue new shares to raise capital. In your mind, and this might be a couple part question, I'm realizing now that there are a few things to touch on here, but in your mind, what is the biggest difference between like a private miner and a public miner when looking for access to capital? Like, what disadvantages does that private miner have that the public miner does not?
I think you nailed it. And I think you provided the answer within the question. But there's other advantages to both structures. The public miner, can issue out, an at the money offer, raise a couple $100 million. Marathon just negotiated a $200 million line of credit collateralized against their Bitcoin. You see companies taking on debt, and there's some healthy debt that you can take on for your company as long as you manage your ratios. Generally, the turnaround time to access those instruments is much faster as a public miner. They're typically audited. They're typically operating within a certain set of standards. They're typically accounting, or at least the market accounts for you, the level of risk that you have in the sites that you've chosen as a public miner. So there's a lot more due diligence around that. So it's easier to underwrite that risk. For a private miner, it's much difficult. Smaller private miner, it's much more difficult to do that. It really comes down to your relationships and the levers that you have to pull in the industry. And that still exists. You just have to pre-establish those. It's just easier to get from 0 to 1 as a public miner versus a private miner. Even just onboarding a public miner versus a private miner is a completely different story, even for us. I think that the private miner does have a lot more flexibility and freedom in where they mine. We're seeing a lot more, miners have had a lot more, clients, long-standing clients of Desk, moved offshore to some parts of Africa, some parts of South America. And so they don't have to ask anyone. They just pack their machines and go. There's no questions. The only person you have to report that to is, your potential investors. And that's about it. You have that ability, you have that freedom. Right. So I do think that's a big difference there. It comes at a trade-off. Comes at a massive trade-off.
Yeah, and for the private miners, you don't have an online mob of investors asking why half your hash rate went offline so that you can move to a jurisdiction that doesn't have the same property rights as the US or Canada or something like that, right?
I think there will be quite a lot of volatility if everybody decided to go down to Ethiopia or
Paraguay or something like that.
Or Paraguay.
We've already seen that with Paraguay too, right? Like I think I'm saying Andy, maybe that's not how you say the acronym, but for their power authority, there have been a bunch of cowboy miners down there who have just plugged in without really negotiating power rates or talking with the power authority, and they've kind of frozen and put any sort of new operations on the fritz, the ones that are still there, and the legitimate miners like Bitfarms and Hive that are operating in the area and already have PPAs in place, they're fine. But for a lot of these new miners coming in, it's kind of been difficult because they can't get power contracts because of all these other ones who are operating in the gray areas and the margins. Last question with private versus public. Is it getting easier for private miners to access capital? And do you think that there will ever be a time when it is just as easy for them as the public companies?
Likely, no. I think that it depends on your structure and how you're incentivizing investors to come in. I've seen a few good structures that have been a little bit more flexible to the investor and provide a little bit of a bigger guarantee. Not to give the names out on the pod, but I think that there is a few different ways that you can appeal to investors more in today's day and age. It if you look beyond the current 4-year cycle, so if you look, to the next halving and after that, well, you have to ask yourself, how profitable is this miner going to be in 4 years' time? So what are those, protection mechanisms? How are you going to hedge your exposure with your miners? How often are you going to change your fleet? These questions are, for newer miners, it's a little bit difficult because they haven't had they haven't experienced the pain that other miners have experienced. And so those lessons haven't been learned yet. And so unless you have somebody that has sat there and has kind of worked through, it's extremely cutthroat business. So if you're not kind of operating from that perspective, it's going to be more difficult for you to raise capital as a private miner, running a farm. So you have to be extremely calculated with your expenses, extremely calculated with your hedging strategies. So currently, no, it's for smaller checks, you can still raise capital if you have somebody that, again, has that experience and has come from that background. For larger miners, again, it depends on your accessibility to capital. And you didn't become a large miner without that accessibility to capital.
It's almost a chicken and egg problem. And like with anything, the larger you are, the more influence you'll have, the more weight you can throw around, and the more likely you are to probably get money on the table because you have the assets, you have the track record, all that stuff.
I mean, I think miners are extremely helpful and friendly people in general. People are extremely willing to kind of jump on a call, help, assist with any issues that might need troubleshooting. There's an endless amount of chats on Telegram where you can just post a question and you'll just see 10 different replies immediately, within an hour regarding some very technical software questions and some very technical hardware questions. So, it's completely different in other sectors in the industry. So, that's why I love the mining industry. It's extremely friendly. People are willing to help, and you just want to see the industry grow. So, I think it's going to continue growing. Hobbyist miners are gonna, still participate in the industry and grow. Seen lots of cool innovation where you have a little setup that helps you heat your home, your building, your pools or bath. There's one in New York that's historic. So these innovations will continue to rise. We're in Canada, so maybe we need some of those heating instruments.
In the Great White North, man.
Somewhere.
It's funny. There is a miner in, I believe, New Brunswick or Labrador. And do you know who I'm talking about? They repurpose the heat from their operations, and they heat like warehouses and
exactly
residential buildings. And it's just, you just the level of innovation within the Bitcoin mining industry never fails to amaze me. But let's just turn into a big circle jerk about how awesome our industry is.
Interested in Bitcoin scaling, startups, or learning more about Bitcoin Softworks? Join us Saturday, November 9th at the Fidelity Center in Boston, Massachusetts for Op Next, a one-day conference on scaling Bitcoin hosted by Blockspace Media, the producers of this podcast. Join Bitcoiners like Peter Todd, Portland Hodl, and more to discuss various Bitcoin proposals like OpCat, the Great Script Restoration, CTV, and more. Attend workshops, speaker sessions, and panels discussing the latest in scaling tech, from ZK to ARC to Bitcoin Softwork history. And for a limited time, use code OCTOBER to get 25% off a general admission ticket. Find out more by visiting opnext.dev. Again, that's October at opnext.dev. You can find out more by checking out the show notes below.
Let's pivot to the 2024 election. I'm just going to kind of come out straight with it. Who is better for Bitcoin, Kamala Harris or Donald Trump?
If you watch the speech in Bitcoin Nashville, you'll understand some of the promises that were made by Trump. Now, whether promises are followed through or not, it's always a question mark with politicians. For me, I think that the Biden administration has been very difficult to operate with in this industry. So I'll say Kamala is good. Trump is better. Trump is, by far for my industry, mining industry, it's supposed to provide a lot more regulatory clarity.
Mm-hmm.
From the banking landscape, I think the operation Chokepoint 2.0 has definitely caused a massive hamper.
I'm really happy that you brought that up, because I think that this is something that a lot of people plugged into Bitcoin news will understand and know. Nick Carter has done some very good reporting on this through Pirate Wires. I recommend everyone go check out his articles on this. He did some reporting a year or so ago, or a couple years ago, that kind of set the stage for like when all this stuff was going on. And he did some follow-up reporting recently. But this is something that just completely does not resonate in the larger news cycle, I think, for a couple of reasons. I think there's still a stigma of crypto being scammy. And so it's kind of like the average reader is going to say, oh, well, they probably had it coming, right? These banks probably deserve to be choked or regulated out of existence. But Chokepoint 2.0 was kind of, and you could speak to it better than I could, so I'll kick it back to you after this, was really this kind of systematic walling off of some of these crypto financial institutions like Silvergate from any source of liquidity in the mainstream financial system, right? Am I understanding that correctly? As far as I know, it was basically the Biden administration and the regulators under his administration closing off Silvergate and I believe another one from the legacy financial institutions.
Yeah. It's Signature, Silvergate, SVB is a different story, but just to touch on Silvergate and Signature, Silvergate had the capital to continue operating. And the issue of everything that we're facing here just comes through from the FDIC. And the FDIC ultimately is under direction to make it a little bit more difficult for banks to serve as digital asset providers. And so currently you have a few banks that are servicing the mining industry and the Bitcoin industry just in general, freely-ish, right? They have capital reserve requirements of percentage of allowed exposure to sectors such as the crypto sector. And in most cases, these banks have gotten warnings saying that you've breached the limit. Well, that limit was arbitrarily set. And, banks like Silvergate had the ability to continue operating, but were ordered to halt their operations and distribute the capital back. Extremely damaging to the industry, as it provided the rails and the plumbing for the industry to operate much faster than where it currently does. And ultimately, the FDIC, Coinbase was just actually came out with this report a few days ago, it was a headline that came out saying Coinbase states that the FDIC ordered 20 different banks to make it more difficult to bank crypto clients. And so I sit there and I'm like, you ultimately force people to then have to use payment service providers, have to use, alternative banks, that neobanks, alternative banking providers that are more offshore in different jurisdictions, not sitting and abiding by, the regulations that were set before, or you're pushing people to leverage stable coins further or Bitcoin further. That's damaging to the innovation that could happen within your country. And so to me, that's one of the big points that, faces a business in the industry is your ability to on-ramp and off-ramp capital. And everything that you do in between, I think that, we're quote unquote self-governing, waiting for further, better regulation. But for the on-ramp and off-ramp, you should have that freedom to access your capital. Currently, very difficult. So
it's a huge scandal, I think, for this administration and for the banking regulators in the United States. And like I said, it doesn't really get talked about like a lot of things in Bitcoin get talked about in the mainstream press. It's just not going to get any sort of uproar. No one really cares because there aren't as many stakeholders, or not. Most Americans, a lot of Americans hold Bitcoin. Most of them kind of look at it like another financial instrument or asset, and it doesn't have the same, I think, purchase with people like you and me who like work in this industry. And sorry to cut you off there, but I also have to ask this: the trickle effects of this don't just affect obviously the Silvergates and the banks who were shut off from these financial from the financial plumbing of the United States, but I would imagine that it also has downstream effects with your business and other businesses. I mean, have you all been directly affected by Chokepoint 2.0? and the on and off ramps being shut off for some of these bigger crypto banks?
Yeah, I mean, we have redundancies in place. So for every fiat currency that we service, which is about 5, we have at least 5 backup banks. 5 backups banks for USD specifically, because sometimes it can be fickle. Euro, GBP, CAD, relatively easier to maintain our accounts. But USD, you might never know what's happening with your partner bank. So for us, we always manage to have backup banks, and always always building up our ability and our infrastructure to add in additional banks. And that serves for 2 different reasons. One is to protect our ability to settle clients, obviously. And number 2 is some of the banks have faster and faster plumbing and infrastructure. So if we're on the same bank as some of our biggest clients, then we can intrabank transfer assets rather than having to wait for a Fed wire. We've been impacted by banks shutting down for probably since the inception of the business. It's more than a handful of banks that have demarketed us, for sure.
This is just a perennial problem for the crypto industry, I think. Ever since I've been covering the industry from 2017, it seems like every year there is some sort of story or instance that I am alerted to of crypto companies being debanked. It just constantly is happening. It's this, like, I don't want to call it a boogeyman, because a boogeyman is usually something that doesn't exist, but it's this nagging pain in the industry's side, right? And I just would hope that eventually we can get past this point. You would think that with the ETF being out, maybe that would help things. But then again, to bring Alex Jones back on, there's a part of me that thinks, well, they want it concentrated within a institution like BlackRock, and they don't want any of the crypto native banks to actually survive. I'm not going to ask you to comment on that, but I would have just thought that at this point, this would be behind us. But, eternal September, it seems, with crypto banking problems.
I hope we'll turn a corner. I'm optimistic. I think that there's a lot of groups doing a lot of really good work on the lobbying side. And I think the fruits of that labor don't show itself immediately. It'll take some time for us to get in the right rooms, speak with the right individuals to turn these rules and, or not rules, but shackles of banking off. And it'll just take some time. I think enough people are doing the right thing in this industry. So I'm optimistic.
I am too, but part of me is pessimistic, but I'll take your word for it because you're involved in the lending side of things and the capital market side of things more than me. All right, last question on the election. Just generally for the macro economy, which presidency do you think would be better? Or is it kind of just not really either of them? Market's going to do what market's going to do.
It's a really good question. I think that there was a very famous video that was kind of circulating by Paul Tudor Jones, and he was commenting on the fact that all roads lead to inflation, and that he's long gold, long Bitcoin. And so, to me, the reason for that is because government spending is at insane levels, and he equates it to a few different scenarios that might resonate with some people. Where if you are earning $100,000 a year, but you're $700,000 in debt, but you're taking on an extra $40,000 a year of debt, it's going to be very difficult. There's going to need to, we're going to have to go through a bit of a period of fiscal contraction. And with that period of fiscal contraction, that happens through some government spending where some people will be unemployed. It'll happen with a little bit of, some programs having to take a bit of a back seat in order to optimize the government balance sheet. And that needs to happen whether Trump is in office or Kamala is in office. And ultimately, those hard decisions sometimes are made by one side versus the other. So I do think that, under Trump, we might see a little bit more of that fiscal responsibility versus Kamala. But you can't be positive, that anything's going to be followed through with. I think that we're going to likely experience a short-term pop with Trump. We'll see a little bit more positive price action. and likely the inverse with Kamal. But I think that overall, we're still poised to continue trending for Bitcoin, regardless of either candidate. The way I look at it is, the president of the United States is kind of a new captain for a very large ship. And it takes a lot of power, it takes a lot of time for the ship to course correct. And these corrections will come with time. But ultimately, Bitcoin is, its own ship, in this race, and adoption is growing. We've highlighted a few different funds that are building up their holdings. There's nation states that are coming out and publicizing their holdings. It'll eventually turn into a bit of a complete point of government arguing of who has more Bitcoin, similar to gold reserves. You'll have Bitcoin reserves starting to build up across states, governments, and sovereign funds. So all roads do lead to Bitcoin hitting $100,000. I'm quite positive about that statement. We'll likely have an easier time under the Trump administration.
Yeah, I could definitely see that. And to do a little political crossover, I believe this woman, Joy Ann Reid, was on a Free Press debriefing after, I think, the Kamala and Trump debate. And she said, no matter who gets elected, she was talking to this gentleman a while back, and she said, this guy told me, the black guy from the inner city, he said, no matter who gets elected, Miss Reid, the hood don't change. And no matter who gets elected this election cycle, Fed gonna print money. Nothing stops this train. So all it's that being said, with the train never stopping meme as our stopping point, Mostafa, thank you so much for joining me. I really enjoyed this conversation. Not a finance guy by background. I'm always fascinated by all of these different concepts because it really is the lifeblood of basically everything that we do. And within the Bitcoin mining industry, what y'all do is indispensable for a lot of these companies. So really appreciate the conversation. Before we go, give us a little bit of a shout out for Secure Digital Markets. Where can we find Secure Digital Markets on social media? Where can we find you? Use this opportunity to shill your bags, sir.
100%. Appreciate you having me on. It's been an absolute pleasure. Your questions, your attention to details is amazing. And really appreciated being on your podcast here. I think that you guys do great work in sharing a little bit more of the intricacies when it comes down to the many factors that come into play to being a Bitcoin miner. So big shout out to the Mining Pod. I think that for us, you can find us at SD_markets on Twitter, and then on Telegram, t.me/Secure Digital Markets. Our website is www.sdm.co. So extremely easy to find us. I'm also on Twitter, LinkedIn, et cetera, et cetera. So hope to hear from you soon, and any questions that you might have or your audience that might have, let us know. We're happy to help or guide you in the right direction.
Awesome. Thank you, Mostafa. Have a good day, man.
Thank you. You as well.